Welcome to Home Biz Tax Talk. My name is Lysandra Everett. I am the Home Biz Tax Lady and the principal owner of Everett Tax Solutions, where we help you win the tax game. Home Biz Tax Talk airs Monday through Friday. And when you tune into my show, you're going to hear about topics that are important to the small business community. All right. So one of the things that is really starting to make its way around is the initiatives of the Small Business and Self-Employed Division of the IRS. And one of those things, of course, is an increase in audits of small business owners. But today, I want to focus on partnerships. Many times I get calls from people that have started partnerships and, gone into business, gone making money and all of that, not really understanding all of the extra behind it. I often tell people when they, call for consultations to create your partnership agreement. No spit shaking. I don't care if you're going into business with your brother or a complete stranger. You need to have the partnership agreement in place because it really tells you how things are going to be done, how the business is going to run and that kind of thing. And I also recommend going to an attorney, a business attorney, to make sure that everything is in accordance with the laws of your particular state. And you covered everything. And 9 times out of 10, people do not do that. Okay. But I want to share with you today something that you may not know. And with the increase in audits that's coming, it can be very impactful to your partnership. One of the things that has changed is the audit rules for partnerships. And basically what comes out of it is that partnerships will wind up paying more taxes. On a normal day, a partnership is a pass-through entity. What that means is that your profits and losses are passed through to each individual partners based on their ownership, and taxes are paid at the partnership level. However, when it comes down to enforcing these things, it can get a little funky because whoever is the partner, when a tax return was filed, it's not audited until 3 years later. Those partners could be gone on to do other things, moved out of the country, all just fell off the face of the earth, all of that stuff. And that presented a problem for the IRS because they got to collect this tax. But what has changed is that now during an audit, the IRS can now collect tax at the partnership level. And it will be taxed at the highest individual level. I think that's what the language says, and which is going to result in more tax. So what does that mean? Generally speaking, when you have a partnership, 9 times out of 10, that person's income is not taxed at the highest individual level. It's generally lower than that, generally speaking, right? But with this new language, that's not necessarily going to be the case. So the new audit rules, first of all, came about in 2015 in the Bipartisan Budget Act of 2015. Okay. The law actually went into effect in January 1st, 2018, and that is what established the new income tax audit rules for partnerships, LLCs, limited partnerships, and S corporations. And that is where all of this language was changed. And now you need to know, especially with these increase in audits coming. So let's look at this because I got to show y'all this case. This was bananas. This was back in November, where there was a guy who was 50% owner of a partnership. He earned money from the partnership, didn't claim the income. He had it sent somewhere else, used the money to, buy personal stuff. Basically, your garden variety tax evasion, right? But now, fortunately, they were able to catch this dude. And I want to, how much money did he say? Yes, a loss of over $4 million. Now, can you imagine being a partnership who then got audited and one of your partners didn't pay their tax, and you then get a tax bill on it says here, that his failure to report additional income cost the IRS more than $1.3 million. Now, can you imagine being in a partnership, you're doing great, and you get this audit, okay? No problem. But then you get a bill for $1.3 million because, hey, they can't find that partner that didn't claim the income. So, hey, you partnership, now you're on the hook for that $1.3 million. That's not going to be cute, right? So what is happening is that the IRS is saying, hey, we're taking this from worrying about these individual partners and we're going to put it in the hands of the partnership, and we're going to collect our tax at the partnership level. Now, there is the ability to opt out of said treatment, but here's the deal. The majority of partnerships out here running around don't even have partnership agreements. So there is no opting out of anything because you have not done the proper thing and sought the proper consultation. This is why you have to have, I keep telling you, spit shaking and going into business with people does not always work out right. It says the additional complexity also occurs when a partner leaves or, is no longer with the business. But it happens before the partnership tax is assessed and audited. So, like I said, that person's gone. So the partnership is still here. The business is still here. And the IRS is saying, great, you write the check. Since they're gone, you write the check. Now, you would be, as the business, it would be your responsibility to go try and collect from that partner. But good luck, right? Because the IRS couldn't find them. You're going to spend a lot more money than them. So what is the takeaway here? First of all, if you have a partnership, if you're in business with someone and a partnership is a multi-member LLC that has not elected any kind of treatment, it's automatically taxed as a partnership, or it's just a straight partnership, okay? If you do not have a partnership agreement, you need to sit down and work it out before you do anything else. Secondly, who is going to be your partnership representative to deal with tax matters? You need to have that. It used to be called a tax matters partner, but now it's called a partnership representative. And it does not even have to be a partner in the business. The partner representative can be anyone, but you want to be responsible with that because the partner representative has a lot of authority that a tax matters partner ordinarily did not have. But, get your partnership agreement in place. Who's going to be your partner representative to deal with these IRS matters? How are you going to track your partners, right? Perhaps it's one of those things where you say, hey, as a partnership, we want to see, get your redacted transcripts to make sure you have claimed said income. So in the event that you are audited, that you not, as a partnership, you're not in any kind of trouble because, some 5% partner didn't do their job, right? So, going into business is really easy, okay? It's getting to the administrative, the business part of the business that's hard. And again, what happens is people just get out here, go into business together and start making this money with no consultation, no agreements in place, no consults with an attorney, tax person, CPA, none of that. We just go out here and make the money. But if something like this happens, when your partnership is audited and some other partner is gone, then your business is on the hook, even if you didn't do it. So just know that partnerships are really very common. It's probably one of the most common business structures outside of being a sole proprietor or a single member LLC. So people go into business together all the time. It's just going into business without the proper structure in place that causes you drama down the road that you don't see coming. So let this be the warning. If you have a partnership and you don't have your documentation together, get it together. Get your partnership agreement in place. Go consult with an attorney to make sure that all of your I's are dotted and your T's are crossed and you're abiding by the laws of your state. It really is just that simple. And so when you find out what the proper language is for your partnership, that can then be added to your partnership agreement. It can be added to your tax return as appropriate, so that in the event that the audit does happen, that you and your business are protected as much as possible. Okay. So that's it for today, you guys. Partners, I'm telling you, don't play with this. That's all I'm saying. All right, you guys, thank you so much for tuning into Home Biz Tax Talk. Again, we air Monday through Friday, and you can come right here to get your questions answered about your home business taxes. All right, see y'all next time. Bye.